Today we'll continue what we started in the last class, and we'll finish up the Part B, Part C debate. Real quick on residual markets again, get into Coverage D, and maybe a few other contract provisions. Coverage D is really the last thing, just some minor things after that. And then we'll get into our big issue on auto insurance, although it does impact homeowners insurance as well, and that's how insurance companies use credit scores to influence how much coverage and what the premiums are for insurance. So let's walk back through. So remember Parts B and C, we're looking at uninsured motorists, we're looking at medical coverage. So they're both, B and C are both medical insurance for the most part. So it's true, if an uninsured motorist hits you, there's other coverages you can get, but the primary coverage is coverage for your medical insurance. So you have another driver who's uninsured or underinsured. That uninsured can have a few perspectives. One is that they don't have enough to cover your losses. Another could be that they don't have the insurance required by the state. They have some insurance, but not as much as required by the state. But there's different rules. We're not going to get into those details because it varies state by state how those are handled, and whether someone's uninsured, underinsured, and then there's the question of how much liability coverage you have versus them. If you're underinsured, should you be able to get coverage from them if they're underinsured? You know, what kind of incentives do we have here? But for the most part, what they're covering is your medical. Your Part D, the damage to your car, that's covered by Part D. Now you may have to pay a deductible, which you wouldn't have to pay if you had it uninsured. It does cover things like rental cars. Your Part D can cover that as well. I don't usually buy towing and labor, but you can buy that coverage as well. And there's a few other expenses that Parts B and C cover that you don't get with other insurance you might have, but you have to ask how important are those. So your financial losses would include medical expenses, loss of income, diminishing your ability to earn income, that's essentially the same thing. Help around the household, you know, hiring cleaning people, even babysitters, those kind of things. And then what I'm going to argue is probably the single most important one is pain and suffering. So medical expenses, this is covered generally by health insurance. Now it's true, if you have auto insurance and another driver hits you and they're at fault, your health insurance company is going to say, hey, we're not going to cover this. You have uninsured motorist coverage, it will cover you. But if you don't have the uninsured motorist coverage, then your health insurance will cover it. So if you have health insurance, you're covered. Loss of income, we call that disability insurance. Do you have that or not have that? So a lot of people do not have disability insurance. I did have disability insurance when I was at USAA. I have some at UTSA, although I don't know how much it is, given that I'm retired and living, you know, I have plenty saved up and plenty of pension plans and everything else. It's not something I'm concerned about, but I probably have some coverage. Same thing here, diminishing in your ability to earn money, that's going to be disability. Household or other related assistance, this is what you have to self-insure, so you have to ask, can you handle that? That's why I live in a small place that's easy to take care of, and I don't have kids that need help, but there are some special issues. And then pain and suffering, you're just not going to be covered. Your own auto insurance does not cover you for pain and suffering when you cause an accident. You know, if you have an accident and you're in pain and suffering, it's not going to cover your health insurance if you have an accident and you're at fault. So you don't have pain and suffering covered a lot of time. So why would you want it in this case? So an uninsured driver hits you, causes you a lot of pain and suffering. Okay, so you have no coverage. Is that important to you? So I have a lot of students, this is the breaking point for them. So hey, if I'm going to be in a lot of pain, I want thousands of dollars paid to me. Well, I don't care about that. Some people do. The other issue though I have with this is people will say, well, there are a lot of people out there that don't have health insurance. There are a lot of people that don't have disability insurance. There's people who want to be covered for pain and suffering. There's people who do need help with the household-related assistance. I say, okay, that's great. So if you do not have other coverage, why would you want it just to cover when hit by an uninsured motorist? That doesn't make sense to me. So someone says, I don't have health insurance, so I better buy Part B and Part C, so that if I get injured, driving a car, I can get those covered. Well, there's a lot of other places we can get injured, other places we can get sick, we can get cancer. If someone doesn't have health insurance, maybe they shouldn't buy Part B and C and instead put all that money, and we'll show you how much it is. It's not a huge amount of money, about maybe $100, $200. Put that against health insurance. I don't have disability insurance, so I better get this Part B and C. Well, if you're worried about not being able to earn income because of an injury, why would you only worry about that in the situation where you're hit by uninsured motorists? Why wouldn't you also worry about that in other situations? So instead of buying Part B and C of auto insurance, maybe you should get some disability insurance, or maybe change jobs to get a job that actually covers your disability. Household-related health assistance, yeah, that gets back to your being disabled. You can't do work around the house. If you have disability insurance, that should provide you income so that you can hire these people to help you around the house. And then the last one, pain and suffering. So you say pain and suffering, that's really important to me. If I'm in pain, I want someone paying me money. Well, why only in a situation when you're hit by uninsured motorists? So that's the part I really don't understand is people need this insurance. Why would they only want it in this very special case where they're hit by uninsured motorists? And then you have to ask, the other question is the probability. And I don't know the math, but I would ask you, how many people do you know that one had died prematurely and left dependents, or two were seriously harmed by an uninsured motorist? I know a few people in category number 1. I don't know anyone in category 2. I've never met anyone in category 2. Now my legal friend who says everybody should be buying this insurance, that debate I had on Facebook, he knows a lot of people that have the number 2 issue, seriously harmed by uninsured motorists, but that's the business he's in. That's what he represents. So he may have a skewed distribution of this. I don't know what the probability is. Both are pretty rare, but I do know a few people who have died during their working years and have left dependents, and so there's some probability there. It's very, very low, but I know more people that have done that than have been seriously harmed by uninsured motorists. So that's the statistics as well. We've got to look at these statistics and say, okay, is this a risk that's really dominant? Because, I mean, that's the other thing. Maybe this person needs life insurance, and life insurance is very inexpensive. The money you could be spending on parts B and C, you could spend that on life insurance to get quite a bit of life insurance. So if the probability of dying prematurely is slightly higher than the probability of being seriously harmed by an uninsured motorist, maybe this person should buy life insurance. Both are pretty inexpensive insurance because they're so infrequent. But maybe this person needs to be allocating. So it comes down to an economic question. What is the best use of those resources? Because if you don't buy B and C in auto, you can spend that elsewhere. And that's the argument I really want to hear is, what is the opportunity cost? What are you not buying because you're spending money on parts B and C? If that's someone that's young and has dependents who's buying parts B and C, maybe the far better answer is they buy life insurance, or maybe buy some health insurance or whatever. So these are the questions I have. You might be the one who says, you know what, all I see is this one thing, like their pain and suffering. I want that covered. If that's not covered, I can't be happy. Even if it's only covered for uninsured motorists, I want that coverage. That's fine. I'm not in that camp. To me, getting money when I'm in pain and suffering does nothing for me. Money means nothing to me. If I'm in pain, I'm in pain. I just want the pain to stop. If I can pay money to get the pain to stop, I will pay money. But someone paying me money where I continue to be in pain and continue to suffer, that does nothing for me. So that's one that might sway you to the other side. Now, a lot of people argue this argument, and this is somewhat the argument that the lawyer friend of mine made, is the fact that someone ever had a claim ever for this insurance is proof that everybody should buy it. But we are talking about very low frequency events, so you can make this same argument for buying lottery tickets. Hey, I know someone who won the lottery, therefore everybody should buy lottery tickets. That's not the way the math works. So it's a weak argument, but you can see his argument here. The claim triggered my collision deductible of $500 was going to be counted as a not at fault claim by my insurer, which inevitably would raise my rates. Shouldn't raise them all that much, but I don't know how much he knows about that. It obviously wasn't so much not his fault that they're going to raise the rates. There's something he contributed there. Here's where the beauty of uninsured motorist coverage comes in. Since I had the coverage and filed the police report showing the damage was a result of hit and run, my uninsured motorist coverage was triggered rather than my OTC. So, yeah, he's trying to avoid that Part D coverage. Why the uninsured motorist wouldn't raise his rates, but the other, the collision would. No, who knows? So he says uninsured motorist coverage works differently than the collision. My deductible was reduced to $250, saved me $250. So right there, he saved $250. All right, this is insurance you're paying probably $100 to $200 a year for, and he's now happy that he spent $200 a year, maybe for the last 5 years. $200 a year, so he spent $1,000, and boy, it finally paid off, and it saved him $250. That's a weak argument. Second, since the damage wasn't my fault, it will now be counted against me in the form of additional premium when my policy renews. That's the same with collision as well. But I'm not real sure of his math there. It really comes down to the simple fact that you file it one way versus another way. The facts is what the actuary is going to look at to decide if your premium is going to be raised. Finally, the amount of money my insurance company covered for my rental car was increased. That's true. You do get a little extra rental car coverage. To me, that's something that I just want to cover myself. This is a prime example with all insurance of why it's a good idea as much as possible. So I absolutely disagree with that comment. Without uninsured motorists, I would have been hooked for more than twice what it ended up paying. Somewhere in the neighborhood of $250, $300 extra is what it was going to cost him. How much is he paying for that very small amount of coverage? Pretty ridiculous. Now, he only had collision issues. So because he only had collision issues, didn't get into the pain and suffering or the health insurance. So, it certainly changes the equation when someone is injured physically, but on his and the OTC, means other than collision. So it's saying, but I don't think he's quite using this correctly in this area. But it's the Part D. It's the physical damage part of your car. And so what he wanted to show is that it's it wasn't my fault accident. I didn't run into a tree. So it's someone else did it. I filed a police report. They're at fault. So don't raise my rates. But anyway, so remember this next time anyone tries to tell you uninsured motorist coverage is unnecessary. If you have a physical damage coverage on your vehicle, you never know when you will come out of the grocery store to find your door smashed and no note left on your windshield. He's talking about such small things. Um, and remember, if you're going to file these kind of small claims, that in itself is going to raise your rates. If someone's going to say, hey, someone dinged my door, I'm going to file an insurance claim, those type of claims raise rates for everybody. So I disagree with many of his basic arguments here. You also get coverage if you're a pedestrian. Why do you get coverage? What we already talked about: medical expenses, lost wages. So what happens if you switch jobs and so you're going to lose your health insurance or whatever? Well, why are you switching jobs without making sure you have health insurance? So if you have family members traveling in other cars, if you're transporting people, yeah, all of this comes down to if your family has medical insurance, if you have disability coverage, then you're already covered for the things he's talking about. He says you probably can't afford to drive without it, but I can, and I don't worry about it. It's a common question we encounter in our practice. I've even heard of insurance agents who express the opinion that people do not need uninsured motorists coverage on an auto if they have health insurance or Medicare. The reasoning seems to be that following an accident, their medical bills will be covered. Unfortunately, this reasoning fails to take into consideration all the other benefits. All right, so this is key. All these other benefits. You talk about a ridiculous list he's going to give us here, but let's look at it. What are all those? The purpose of uninsured motorist coverage is to compensate the insurer for all of the elements of damage that would have been entitled to receive from the person causing the accident, but who didn't carry the insurance. What are they? All right, pain and suffering. We've already talked about those. I agree. Those are covered. Disability, scarring, disfigurement. That's all the same thing, isn't it? Mental anguish. Why is he listing mental anguish in addition to pain and suffering? Loss of enjoyment of life. I mean, isn't he just essentially list the same thing several times? Lost earnings, yeah, that makes sense. Earning capacity, that's the same thing as well. There's two. That one's covered by disability insurance, as well as unpaid medical expenses. So he's listed 3 things here, but he makes the list look like it's 10 things. Of this list, the only ones would be covered by health insurance or Medicare would be covered medical expenses. That's true. Medical insurance covers medical expenses. Disability costs covers lost earnings. And everything else on that list is pain and suffering of some kind or another. And yeah, that you would not get covered. No one ever believes they'll be involved in a serious motor vehicle accident, but every day throughout the state, hundreds of people are seriously injured. Hundreds of people. So what probability are you talking about it? Hundreds of people are in auto accidents, but he's talking specifically about the number of people in serious accidents where they're seriously injured and the other driver was uninsured. So we're not talking about the general, we're talking about a very specific case. The injured person will immediately begin to consider who will compensate them for the losses. Losses such as pain, suffering, and Ben, he loves long list here. In more serious accidents, all those losses may be incurred, particularly those which involve death. That's another one. If you don't have life insurance, do you want life insurance that's only going to cover you in case you're killed by an uninsured motorist? That seems a little bizarre to me. People naturally become angry and frustrated when they've been stuck with an uninsured driver, only to discover their own policy of insurance doesn't include uninsured motorists. There's something else to consider about carrying only Medicare. If there is any liability coverage available, provide compensation for one's injuries, even though it may be woefully inadequate. Medicare and virtually all health insurance policies have reimbursement rights. The federal statutes require reimbursements of benefits provided by Medicare when the injured party receives compensation for their injuries. Most other health plans contain reimbursement rights are regulated. This means that when someone's health insurance Medicare provides benefits to them, those benefits are subject to being paid back to the injured person successfully gets compensation. So, big deal. Why is, and I'll show y'all, eventually I'll show you the Walmart case here later in the semester we're talking about. But it's a case where Walmart actually reimbursed health insurance because the person sued. I want to show you that case because the problem with that case wasn't Walmart getting reimbursed. Because Walmart's argument was, hey, we're here to pay for your health issues, but someone else paid for those. If someone else paid for them, you shouldn't get paid twice. So we won't reimburse. The problem was how inadequate the lawsuit was that the person filed. They weren't getting compensated enough, and so Walmart probably should have just dropped it and let it go, but Walmart actually had a legal requirement by their health insurance plan that they had to actually go after this person. They really didn't have any choice by the contract. If they said just let it go, they would have opened themselves up to lawsuits from other employees saying, why aren't you managing? No, it's doubtful. My guess is if they just let it go, it wouldn't have mattered. But I'll try to find this case. I do have a link to it. It's an interesting case, but I really think it's a case of it's not the problem being of reimbursement rights. It's a problem of the person not suing adequately for their actual pain and suffering. So the only way someone may protect themselves is to carry the maximum amount of uninsured motorist coverage they can afford. So yeah, sell your house, sell all your possessions, and put every single penny you have into the most uninsured motorist coverage you can have. That obviously is not a good actuarially stated position. We urge our clients to examine the declaration sheet, determine what coverage they actually have purchased, and call their agents to get a quote. And I'll show the amount here that I actually would pay. This is on the medical payments only part, health insurance. If you already have sufficient health, life, disability, consider eliminating and purchasing decreased amount of medical coverage for auto insurance. Keep in mind that unlike your health coverage, medical payments coverage is not generally part of HMO or PPO and may provide greater flexibility in care. But that's a pretty weak argument. Usually what I hear on the medical payments part is if you're driving people in your car who don't have insurance. And so if they don't have insurance and you're not hit by an uninsured motorist, you just have an accident, it could be your fault or whatever, and they're injured, then your medical only payments will cover them. However, if you're at fault and they're injured, they can still sue you, so they can still get coverage under Part A of your auto insurance. Or if the other driver's at fault, they can sue that other driver and get their health covered. Or, since they're driving your car, you would be covered by their auto insurance. Now, if it's uninsured motorists, we're talking about uninsured motorists, so if you had Part B or Part C, it's all the same issues. Do you need that health insurance? My opinion is everybody should have health insurance. So there's people walking around without health insurance, and they want me to be incredibly careful anytime they're in my presence because they don't have health insurance. That just seems kind of ridiculous to me. Do I do the same thing with someone else that doesn't have life insurance and say, well, I was going to play football with you, but I'm worried I'll throw the football at you and you'll trip and you'll die and you don't have life insurance. Do we need people to come to us with a list of the insurance they have so we know how careful we got to be with them? It just doesn't make sense to me. So anyway, you've got to think about frequency and severity. You got to think about what you're paying for, what exactly is the best use of your money. So I'll just show you at the very end here. I actually gave you my policy. This is a couple years old, but not that old. So I was paying for parts B and C. I was paying $122 a year. So about $10 a month. You might say, big deal, $10 a month, but it's $122. If I took that and bought life insurance, what I did with this money is I actually applied it to Part A and picked up a few $100,000 of extra liability coverage, which is what I wanted. That was what I was more concerned about. So I ended up with a lot more liability coverage, and I just didn't have Parts B and C. So I'm not recommending you do anything. It's your decision, but I'm just letting you know the lay of the land here. All right, so when you have these uninsured drivers, maybe they're uninsured because they just cannot get insurance anywhere. Maybe they're uninsurable for some reason. Maybe they just can't afford it. Maybe they're really bad drivers. So residual markets, what they're trying to do is try to fill the gaps. These people who don't have auto insurance because they just can't afford it, they've been denied coverage. So the goal of residual markets is to make sure these dangerous drivers who can't get insurance because how dangerous they drive, we want to make sure to put them on the road so they can drive. Now I'm being a little facetious there, but that is true in a lot of cases. The people in these residual markets are more dangerous drivers than people not in residual markets. There's several types, and you don't need to know the difference in the different types. It really just has to do with the way it's set up in the state and who governs it and how the insurance companies reimburse. But essentially the way they all work is there's drivers who can't get insurance. They go to insurance companies. They get turned down. They have to show proof that they've been denied coverage. Once they have proof they've been denied coverage, they can go to these residual markets and they can buy insurance from the residual markets at state mandated rates that are usually much, much lower than the rates they should be paying. They're usually artificially low rates. And then whoever's running this program will allocate those drivers out to all the insurance companies. Pro rata. So State Farm's 20% of the market, State Farm's going to get 20% of these allocated to them. I remember dealing with these where I worked. They were huge loss businesses. There's just no way to make money on this. You always paid out more in claims than you received in premiums. And there were some states, we'll talk about this later as well in the class, we're going to go through an article that talked about some of these market crises where markets just completely shut down because of these residual markets, where they had over 50% of the people in the state were insured by a residual market versus being just insured normally. States like New Jersey have just, it's just been a disaster. And we'll talk about that. We'll get into why that would happen, what's driving that. All right, the next coverage is Part D, pretty important. That's for damage to your auto. So there's collision and then there's other than collision, so comprehensive. So collision is you're driving, you're moving, and you pack another vehicle or another object. And then there's other. That's essentially all risk for anything, any kind of damage to your car. And again, this is, we're talking about uninsured motorists. If you get hit by uninsured motorists, your Part D will cover you after you pay your deductible. So it's not like if you don't have uninsured motorist coverage and you get hit by, if your $50,000 car gets totaled by an uninsured motorist, it doesn't mean you're not covered. Your Part D will cover you over your deductible. What about rental cars? So I don't want to get in rental cars because it's, state by state, and I don't want to get into all the details here, but if you have a car that you use, it's available for regular use by the name insured, the auto is in custody or being used by the name insured or family member, what you have to do here is you got to make sure that's insured. You cannot have a car that you use on a regular basis and not let the insurance company know that you're using that car. So if you don't have the cover, so be careful. If you're constantly borrowing the same car and using it over and over again, and you're thinking, wow, this is great, I got all the coverage out of my auto insurance, also applies to this car, so I'm covered. But it's not my car, so I don't have to worry about putting it in the declaration. Just be careful on that. If it's a rental car, that is covered by your Part D. So if you're renting a car, you do have coverage. So if you wreck a rental car, your Part D will cover you over the deductible. Rental car agencies used to push special rental car insurance, and that used to be a big part of how they made money. Most people have learned now that that's really grossly overpriced insurance. I remember once I had to leave my car at Redmond Combs, and Redmond Combs says, hey, we provide a free rental car. And I thought, wow, great, a free rental car. So I go over to get my free rental car and discover the guy who's giving these free rental cars, his entire business is making money off the insurance. So yeah, the car is free, but you need to buy insurance. And I told him I didn't want the insurance. And boy, he laid into me. He was so mad. But I said, I do not want the insurance. Well, the insurance he wanted to charge me was like $40 for one day. Think about that, $40. Take $40 and multiply it by 365 days or 400 days. You're talking, what is that, $16,000? Would you ever pay $16,000 for auto insurance? I mean, it's ridiculously overpriced insurance. So I turned him down. So I discovered that this free rental car was really some guy's business to make insurance premiums and make really high insurance premiums. So what happens if you have that situation where you're renting a car and you want to know your coverage? You're covered. Well, The best thing to do is if you're going to travel, call your insurance company and have a discussion. It can make a big difference. So if I go to Mexico, I'm not going to rent a car in Mexico. The rules are too complicated. It just, I know my insurance from the U.S. doesn't cover me there, so it's somewhat frustrating. So there, I'm going to use Uber or whatever. I'll use a taxi, even if it's more expensive, because the more expensive Uber and taxi is going to be much less than what auto insurance you'd be required to take. Now, I have rented a car in Costa Rica. There, it's really frustrating. They have really strict rules about what insurance you have to have, and you have no choice but to buy it. And it is expensive. The insurance was more expensive than the rental car. I was shocked at how cheap the rental car was. It was maybe $500 for a really nice SUV for an entire 8 or 9 days. I mean, it was just ridiculously inexpensive. Really nice SUV. Something would probably go for, I don't know, 40–50% more in the U.S. But the insurance that we had to buy was several times larger. I mean, it was much more expensive. So if you're going to travel, call first. I once did a trip to Greece where we went there. We went to rent a car, driving around, and then our last trip was to Athens, where we're going to go sit in and watch the Olympics. We did not call in advance. We didn't check. And in Greece, the insurance there was incredibly expensive, several $100s for insurance for just a few days, just a couple of days. It was really expensive. So very strongly recommend anytime you travel, call your insurance company and check. Now in the U.S., you probably don't need the insurance, or what a lot of people do is a lot of credit cards will provide coverage for auto rental cars. So just make sure you use the right credit card and that you're covered. Your liability coverage will definitely cover you while you're in a rental car if you're in the United States. Outside of the United States, everything changes. So don't assume you're going to travel to Europe and rent cars and everything's going to be normal just like in the U.S. You need to call your insurance company and check on that first. All right, so let's talk about conclusions. I mean, there's some obvious ones that we talked about in Part A, but damage due to wear, tear, freezing, mechanical, electrical. So auto insurance is not a maintenance policy. I know you can buy maintenance policies now. They seem somewhat overpriced. You probably get that phone call about, I'm Wendy from wherever calling you about your auto coverage or whatever, maintenance coverage, that it's expired or whatever, your warranty. But that's not what auto insurance is. Auto insurance is not covering for wear and tear and damage and that kind of thing. There is maybe some definition issues. What is due and confined to? So if you have an accident and there's some things going on, it's just there's some mechanical problems in your car, and so to fix your car from the accident, they're also going to have to fix those mechanical problems. There can be some debates, so your insurance will walk that through with you once they get the adjuster out there and review the losses. There are loss payees that so if there's something you've done that would keep you from being covered, the mortgage, the bank lender may still be covered, even though you may not be covered. So you may not be able to get any coverage, but so the insured's not covered, but the loss payee, the person making the auto loan, could be covered. Equipment in your car is not covered unless it's permanently attached, because that's covered by your homeowner's insurance. So if you've got golf clubs in the back of your car, or in my case, I made the stupid mistake of leaving my bike, pretty nice bike, $2,000 bike, in the back of my car, and someone smashed out the window of my car with a brick and stole my bike. So the broken window would have been covered by the auto insurance, but the bike was covered by my homeowners. My deductible on my auto was so high I didn't even mess with the window. I just got it fixed and paid for it myself. But the bike was covered by my homeowners, and I got full reimbursement for that. So you're still covered if you have homeowners insurance. Auto insurance is covered by actual cash value. So it's essentially the value of the car minus depreciation, what you paid for it minus depreciation. They'll pay you actual cash value unless it's cheaper to repair or replace the car. There is a coordination of benefits. So like with rental car insurance, if if you buy the rental car insurance, then your personal auto policy becomes just the excess loss. The renter's is first coverage. Um, and one of the advantages of the renter car insurance is that it covers you without you having to pay for anything. So it keeps you from having to cash out. So if you don't buy the rental car insurance and you wreck a car, the rental car company wants money immediately. You're going to have to put that on your credit card to give them cash or some kind of deposit. And then your insurance company will reimburse you later. But if you have the actual rental car insurance, then you don't out that cash. You're covered. They take care of it. So there is a slight advantage there. A few other parts of the policy, again, I said these are pretty minor. Part D, what are your duties? Part E, what are your duties after an accident? You got to notify the insurer, proof of loss. If there's any investigation, you have to participate there. Protect the property from further loss. Notify police promptly. I had to notify the police when I got my window smashed in, and boy, the guy I talked to, he was about as apathetic as you could be. I think he does far too many of those calls on a daily basis. There's a lot of general provisions. Just one we kind of talked about is the right to subrogation. The insured, if you're in an accident, don't start negotiating with the other driver. I've seen this so many times. I remember one accident, the guy who was driving the car I was in, he wasn't at fault. He said the driver at fault, and the other driver was like, "Hey, why don't I just give you $50?" And we called the whole thing off. And the driver of my car was real smart. He says, "No, I'm not going to do that. I don't know what damage you've done. I don't want to get home and find out you caused some major damage to my car." But this guy wanted to pay the $50 because he didn't want his insurance company to find out about it and raise his rates. Well, if you do that, if you negotiate with the other driver and say, "Yeah, $50, that'll work," and then you get home and find out the damage is much greater, then you essentially jeopardize your own insurance, because you've now done something that the insurance company has the right to do. And we talked about the policy territory. You got to be really careful, especially overseas, as far as what coverage you have or don't have. There are some endorsements you can do: extended transportation expense coverage, so kind of rental car coverage. Towing and labor is there. I don't buy any of these. One nice thing about your insurance policy is if you drive to another state that has other provisions that are more stringent than your state, then your personal auto policy automatically upgrades and gives you that other coverage without you actually having to pay a higher premium. So you're essentially getting additional coverage without having to pay for it. All right, so that's auto insurance. Kind of dry stuff, but I'm hoping you're going to your policy and looking through this, especially the debate on B and C, and just thinking about it. Not that I want you to change your policy because of me, but thinking about these issues, but thinking about them as an actuary or thinking about them as a finance person, and not getting these over pushed hype from insurance salesmen or from insurance saleswomen or from lawyers. Or others who've had a claim say, "You got to get it." Sit down and do the math. Is it worth $122 for that coverage? Part D, we talked about rate online. What should your deductible be? And sit down and do the math on that. Think about how much is more is my premium if I switch from this deductible to another. So there's some good economics in this. What I want to move to now is this incredible issue that comes up mainly with auto insurance. It's a bigger issue with auto insurance, but it's also true for homeowners insurance, where insurance companies use credit scores to rate policies. What do we mean by rate policies? By rate policy, we mean the insurance company decides how much to charge you based on your risk, and they're going to use credit scores to do that. Now, I had a student actually write a paper on this topic. And there may be a paper 2 topic here somewhere. I don't want it to be exactly this, so you have to go find another angle to it. His paper was on how this was unfair. It really didn't tell you anything. I took his paper to the actuaries where I worked, and they said he's absolutely wrong. Credit scores are absolutely beneficial in the pricing of auto insurance, and they were adamant. They said it's not even close. So I'll trust the actuaries over a student who was mad because of their premium, unless you want to provide some study. So if you can find some strong study, a really great article, good research that contradicts what we're going to be looking at here, then yeah, talk to me. I might be open to that. Maybe you'll radically change how I cover this topic in the future. So what I want to do here is there's a couple of documents out there on Blackboard. You'll see there's a document that says credit scores, Article 1, then you have Article 2, and then there's a third article. So Article 1 is the one we're going to start with one exception. I'm going to start you with Article 2, and you'll see why I want to look at Article 2. Article 2 has some definitions, so before we get to Article 2, let me give you these definitions because this is pretty critical to understanding this entire issue. So Article 2 has 3 types of the discrimination listed. And I don't like the definitions of these because I actually think the unfair discrimination and intentional discrimination are actually switched. I would have actually defined them differently. And so to me, I'm not real picky that you know which is which. You just need to know the 2 exist and what they mean, whether you get the right title on which one or not. So the first one is unfair discrimination. So unfair discrimination is when you have 2 people who are really the same risk, but you charge one more than you charge the other. That's called unfair discrimination. So anytime an insurance company charges one person more than they charge another person, they must justify that with data, with statistics on frequency and severity. So they want to say, hey, you know, people with red hair are better drivers than people with brown hair. So we're going to charge redheads 20% less. We'll charge brown-headed people 20% more. Can you do that? Well, if you can really prove that redheads have fewer accidents than brown-headed people, then you know, if hair color really influences driving, then maybe you could get the state to approve that, and you could actually put that in your pricing. We're going to actually look at what insurance companies price on things like gender. So age discrimination is legal with insurance. Age, obviously, young drivers pay a whole lot more for insurance than older drivers, so age discrimination. So gender discrimination, age discrimination are both legal. Where you live, your zip code, that influences it. There's been a big debate on that, that's just not a form of redlining, which gets us into the second one, intentional discrimination. But insurance companies are allowed to discriminate, but they cannot discriminate without the data. They must have the data, so they have to prove that they're going to charge men, 22-year-old men, more for insurance than they charge 42-year-old women. They can do that. That age discrimination and gender discrimination is legal as long as they can prove that they have the data that those drivers drive differently. Now the second one, intentional discrimination. This is overt classifications or discriminations based on race, color, religion, or national origin. And these are illegal even if you can actually prove. So if you can prove that green people drive better than purple people, you cannot charge green people more or less based on that, even though the data is if it's really overwhelming. Green people are really horrible drivers. I can't remember how I said it the first time. Green people are really horrible drivers. Purple people are really great drivers. You can't charge green people more because that would be a race or color. So that's called intentional. Again, to me that feels more like unfair discrimination, and the first one feels more like intentional discrimination, but I'm going to go with their definition. So you can't do that. You notice what's not in that list. Age and gender are not in that list. That age and gender would be in other people's list that would be illegal. But with auto insurance, homeowners insurance, well, homeowners maybe not, but auto insurance, age and gender are definitely allowed. Now the third, so these first 2 are illegal. You cannot do them. The third one is not illegal. And the third one is what is referred to as disproportionate impact. Now I'll tell you, when the insurance commissioner of Texas, Montemayor, came and spoke to my class about this issue. This is one of the issues we spoke about. He also talked about the mold issue. So those are the two, credit scoring and the mold issue. He said this term really doesn't exist. They made it up for this study. He was really pretty negative on the whole concept of disproportionate impact. But what disproportionate impact means is, I'll just read their definition, is lack of symmetry or unequal percentages. So what does that mean? Well, what they're talking about here is there's an uneven distribution of how premiums actually come out by race or some other class that's not allowed here. So race, color, religion, or national origin. You will discover that people of certain race are actually charged more for insurance than people of another race, even though race is not part of the pricing, because there's some other third factor that happens to be correlated with race. That's called disproportionate impact. So the most obvious one is zip code. Obviously, people in different zip codes have different risk. Obviously, people in different zip codes, there can be different minority groups that live more concentrated in certain areas versus others. And if it's the inner city, you might have more crime rates. So you put all that together, it's possible when you bring it all together that there's certain races that are actually being disproportionately harmed because of all the other factors you have. And so I remember Jesse Jackson, he ran for president, he actually had some meetings with the insurance industry on this very issue of what can you guys do so that people in the inner city don't pay so much for insurance. Yes, it's true that the rates should be higher because the frequency and severity is higher, but you're ending up charging people of certain race more than you do of other races because of that. And the industry had a firm discussion with them, and there was actually some agreements, and I think Jackson actually came away feeling like they have accomplished something. But that's the disproportionate impact. It's not illegal unless it's an obvious direct substitute. So if you can find something that has a 99% correlation to race, and you can't discriminate on race, but you're going to use that factor to discriminate on, that would probably be illegal because it's almost a one-to-one substitute. He used the word surrogate. In fact, I love this sentence so much. This is such a great sentence, but he uses the word surrogate. So disproportionate impact changes over time as well. There's not a fixed point. You have to keep reassessing it. But it is not illegal unless it's a direct substitute. So what is the problem with credit scores? The reason people don't like credit scores used to price auto insurance and homeowners insurance is because they don't see the relationship. What is my credit score? I have a low credit score. What does that have to do with how I drive? Someone else has a high credit score. What does that have to do with my driving? And the answer is, who knows? But there's a relationship. And so we'll talk about this a little later. We'll talk about correlation versus causation. Do your good credit scores cause you to drive better? Probably not. Do your bad credit scores cause you to drive worse? Probably not. Or it could be the other way around. The fact that you're a good driver, does that cause you to have good credit scores? Probably not. The fact that you're a bad driver, does that cause you to have bad credit scores? Probably not. There's probably some third factor. That third factor might be something as simple as personal responsibility. People who have personal responsibility, who take charge of their lives, they are going to be better drivers than people who don't. Seems pretty obvious, but there's no way for an insurance company to go out there and figure out who has good personal responsibility, except for maybe credit scores. Look at their credit scores. Now, you might say, wow, this is terrible devil counting because young people get charged more for insurance because they're young, and they also tend to have lower credit scores, so this is like doubling up on these poor young people. Well, it doesn't really double up because the insurance company is going to take both those in consideration, and they're not going to just charge you twice. They're going to charge you a rate that reflects both the fact that the person has a low credit score and they're young. So those two will both be combined together, not to double it up, but to reflect what that combined correlation is. Now, does that mean there are no people with great credit scores that are horrible drivers? Does that mean there are no people with terrible credit scores that are great drivers? Absolutely not. And I'll talk about one of the solutions to the credit scores when we talk about telematics that can give us maybe an out on this issue. For those people, we call those false positives, false negatives. So a false positive is someone has a bad credit score, but they're actually a good driver. False negative, someone has a great credit score and they're actually a bad driver. So false positive, false negatives, they obviously exist. Obviously there are people out there with terrible credit scores that are very good drivers. But the insurance company is not looking at it like that. They're not looking at individual people. They're looking at the class because that's what they're insuring. And the class data is incredibly predictable and incredibly reliable for pricing insurance. All right, so let me give you the bigger, before we get into the study, let me give you the bigger picture and then we'll go into that second article and then show you the introduction. So the state of Texas, really the only state that has done this. I've not heard of another state doing this. That's why I'm giving you something a little bit old, because I just don't think any other state has actually done a study like this. But the insurance commissioner was approached by the Texas legislature, and they say you must do a study on the use of credit scores for rating auto and homeowners policy to determine if that should be illegal in Texas. That is the use of credit scores either unfair discrimination, so we're charging people with bad credit scores more for auto insurance even though they drive just as well as people with good credit scores. So is it unfair discrimination, or is it intentional discrimination? Are credit scores a proxy for race or color or religion? It's just kind of a, as he calls here, a surrogate. So that's the first study. So you can see, boy, I love this term. Are credit scores a surrogate for something sinister? I don't know how he worked, but a good alliterative statement there. A surrogate for something sinister. If that's the case, then that could be intentional discrimination. We're using credit scores because we can't use something else, even though credit scores highly correlates with that, so we're essentially using that other thing that is illegal. Alright, so they want to see is our use of credit scores either intentional discrimination or unfair discrimination. If it's either one of those two, the Texas Insurance Commissioner can disallow it. They can make it illegal. If it's the disproportionate impact, the Texas Insurance Commissioner cannot do anything. That is legal. They don't have the legal right to tell insurance companies they can't do that. Only the Texas legislature can do that. Now, Texas legislature, just like they did in California, could pass a law to make the use of credit scores illegal. But the Texas Insurance Commissioner cannot do that. Alright, so, and then the key of this is there's two phases of this study. So let's get into that. I'm going to now show you you're going to see why I like this as a good place to start. So this is the second article, Article 2 on credit scores. It's an article by Jose Montemayor. This is the gentleman that spoke to my class a couple of times. Really, really interesting speaker. I wish so much that I have him talk to our class. He's writing a letter to the governor of Texas, to the legislature, with the results of this study. And he's written it extremely well, and it's a very political document, and he has to be real careful. But he says, because the Texas Insurance Code does not prescribe precise threshold or legal definition for determining disproportionate impact, I express this disproportionate impact in terms of a relationship over or underrepresentation in the various credit score categories. So there's two phases. The first phase was essentially to ask the question, is there a relationship between credit scores and car accidents? Is there a relationship between credit scores and people filing claims for homeowners? Alright, I'm going to tell you absolutely the answer to that is yes. There is a relationship. So why is he doing this second study? To answer the question, there's definitely people with good credit scores drive on average better than people with bad credit scores. Why are they doing the second phase? Well, the second phase is to figure out if credit scores enable the insurer to more accurately predict losses when they bring other variables together. So we just mentioned one. Young people tend to be worse drivers than older people, and young people tend to have worse credit scores. So why not just not use credit scores because you already have age? Isn't age a good proxy? And you're going to find the answer to the second question is credit scores do provide very important additional information over and above that you can get anywhere else. What that means is young people with good credit scores definitely drive better than young people with bad credit scores. The only reason their credit score is good or bad is not because they're young. Young people with good credit scores are responsible, and they also tend to be better drivers. Now, if you don't have a good credit score and you think I'm calling you a bad driver, I'm not. There are plenty of false positives out there, so it's actually a high percentage. So there's, who knows, 10, 20, 30%, who knows, but there's a good percentage of low credit scored people that drive well. So the second phase indicates that credit score significantly, that word right there, highlight that word, extremely important, significantly improves pricing accuracy when combined with the other variables. So it's additional information, especially for auto insurance, maybe not as much for homeowners. To approach the development of a credit scoring policy, it is important to understand the distinction. So here's these discriminations: unfair discrimination, intentional discrimination, disproportionate impact. The TIC, the Texas Insurance Code, defines unfair discrimination to be unequal treatment of individuals in the same class. Overt discrimination, classifications based on race, color, religion, or national origin are intentional discrimination and are prohibited by law regardless of actual support. So we've already covered that. Disproportionate impact is a lack of symmetry, unequal percentages, so people are unevenly impacted by racial group, and we're specifically looking at racial group probably more than anything else. We'll talk income as well. Obviously, you're going to think people with low credit scores are going to tend to be lower income. It's kind of surprising how many high income people have bad credit scores in the United States. But we're really probably focused more on race. Has been the touchy issue for this. So is a relationship between credit scores and race, and there is some relationship there, which means certain races are being disproportionately harmed by the use of insurance companies using credit scores to rate policies. Now, here at the very end, someone might say, well, let's just end all discrimination with insurance. Let's just stop. And even certain countries like France have actually gotten that and say you can't charge men and women different rates for insurance, which harms women and helps men when it comes to auto insurance. But so there are some that say, hey, let's try to get rid of discrimination. But what Montemayor says is, by the nature of risk-based pricing underwriting, all factors used in insurance have a disproportionate impact to some extent. One could make a convincing argument to ban the use of all risk-related factors based solely on disproportionate impact. We would ban risk-based pricing underwriting and revert to a pricing system where we homogenize the risk and essentially charge everyone the same price. That would not work. We'll talk later in the class why that doesn't work. Good drivers would simply stop buying insurance, and bad drivers would buy way too much insurance, and the whole thing would spiral out of control. So he says, as a commissioner, I can halt unfair and intentional discrimination. I do not have an ability to halt disproportionate impact if they're actually supported and are not unfairly or intentionally discriminatory. Now, what he says here, I think he's wording this a little bit stronger than was the case based on what he told the class. I'm not saying he's lying here, but I think he worded it as a little more positively. But he says, prior to the study, my initial suspicions were that while there may be a correlation to risk, credit scoring value and pricing underwriting risk was superficial, supported by strength of other risk variables like age. I'm not sure he really... I think it's more that he thought it was possible that would be the case, but Montemayor is a very quantitative person. He had a lot of math background. He understood what the actuaries were saying. I think he knew deep down there was a relationship. So I'm not going to question his honesty in here, but from what he told the class, I think he was always pretty confident there was a relationship. If this was proven to be the case, I would have had legal basis to make the connection between the disproportionate impact and intentional discrimination. So if he could show that 100% of green people have bad credit scores and 100% of purple people have good credit scores, and you can just look at credit scores and you can tell if a person's green or purple, that's illegal. That would be intentional because you're just using credit scores as that surrogate. The study, however, did not support these suspicions. Credit scoring, if is continued, is not unfairly discriminatory. It is not based on race, nor is it a precise indicator of race. There are white people with bad credit scores and good credit scores. There are black people with good and bad credit scores. There are Hispanics. There's Asians. There's Native Americans. There's all races are full of people with good and bad credit scores. Not only that, but within races, the people with good credit scores drive better than the people with bad credit scores. So it does give you additional information beyond just the obvious. All right, so that's his letter. I like how he kind of gives a little political plug at the end. If the presence of credit scores and insurance will only feed suspicion and divide us as Texans, its continued use to any degree may simply not be worth it. I don't think that was what he's proposing or he wanted. I think he was a very strong supporter of use of credit score, but that's a good thing to throw in there to kind of give the politicians something to work with. So what we'll do next session, and you'll really want to have the two articles up, both Article 1 and Article 2 up. We'll come back to this one to look at some of the charts, some of the data here at the end. I did highlight it, and you are welcome to read just the highlighted sections if you like. If you don't want to read every single line. There are some things in here I think actuaries you would find pretty interesting, so I'm not saying actuaries you have to read every word, but you might actually want to go through especially when they get into statistics. And I think it's interesting, this phrase, and we'll talk about this, they make a distinction between methods that are statistical and methods that are actuarial. And I'm not quite convinced what they mean by that, because actuaries are obviously very statistical. But I think what they may mean is that actuarial science has some very specific applications, specific just to insurance, that you don't see in general statistics. I think what they mean, we can look and see if we can come up with what they're saying here. All right, so we've introduced the concept. Next class, we'll really get into it in depth. It may be a little touchy. We'll see. Hopefully, no one gets upset. It is a little bit of a touchy issue. It's a touchy issue for Montemayor, but we'll get into it and see what we can do with it.